Welcome to NDTV and BQ Prime special segment, Let's Talk Business. I'm Parmeshwar Bawa, and this is where you can catch the top news stories from the world of business and finance. Markets recorded the biggest single-day fall in nearly 2 months as HDFC twins drag. Banks, NBFCs, media fell in trade, whereas auto and consumer durable shares advanced. Nifty closed below the 18,100 level, whereas the Sensex dropped to 61,054. My colleague Alexander Matthew is here with the wrap of all the market action. Over to you, Alex.
Well, the indications were that there would be selling in the Indian equity markets based on what we saw overnight on Wall Street and also on account of the gains that we've had over the course of the last couple of weeks. Now, that is exactly what we saw. In fact, the selling pressure accelerated over the course of the trading session, and in fact we ended at very close to the low point of the day, and we've erased all of the gains that you saw in trade on Thursday. The Nifty 50 still holding above the 18,000 mark though. Let's take a deeper look into what contributed to this. And if I look at the sectors that have moved very sharply today, you have the Nifty Bank that was the worst off. It lost about 2%, or in fact more than 2%. You had metals also as a pack that underperformed, losing over 1%. The ones that bucked the trend were auto and consumption. Now, the devil is in the detail, and you have to look at a few of the names that stood out in trade today. And if you look at the Nifty 50, a large part of the contributor to the decline today was the HDFC twins, and that's on account of the announcement of the addition of HDFC Bank into the MSCI index, but the expectation of inflows on account of that inclusion is now proving to be false. There will, in fact, as a result of that inclusion into MSCI, be an outflow, and that was reflected in the stocks today, both of them losing about 5% each. And the financials, as I mentioned, also lost ground. Now, a few of the other stocks from the broader universe that you should focus on are the tire stocks, and that's because there was a very positive result from SEAT, and the effect of lower crude prices is now evident with margins expanding. MRF also saw that rub-on effect. You had metal counters, as I mentioned, that underperformed, and that was evident for Hindalco as well as Tata Steel. You had oil marketing companies that are in focus again because of crude. Now, a couple of the other companies that did well on earnings was TVS as well as Hero MotoCorp from the auto pack. Two-wheelers seem to be back in focus. But as we head into next week, we're winding down the earnings season. That will continue to be the focus. But let's see if we hold on to that 18,000 mark. That will be the crucial level to watch out for.
And as we briefly mentioned, shares of HDFC Bank and HDFC plunged during today's trade. This amid a report suggesting the merged HDFC entity could see $150 to $200 million in outflows, as MSCI intends to add the merged entity to the large cap segment of MSCI Global Standard Index. Addition to the index will come with an adjustment factor of 0.5. The fall comes even after HDFC posting a healthy set of numbers in Q4. The mortgage financier's profit rose 19.6% year-on-year in this quarter. We spoke to HDFC's Vice Chairman and CEO Keki Mistry. Listen in.
I think growth will come from all segments of the market. If the monsoons are good, rural economy also picks up, then you would see a fair amount of growth coming from the smaller segments of the smaller towns and cities. The last couple of years, the growth has been a little more in the bigger cities compared to what it used to be. So if the smaller cities also start growing, then obviously the growth momentum will be strong. So my sense is the growth will come from all segments of the market, and the growth opportunities going forward, particularly in the banking structure, are enormous because of the fact that the bank has so many branches which do not distribute housing loans today. But once the merger is completed, all these branches over a period of time are distributing loans. And as far as the last quarter was concerned, March 2023 was the highest level of individual loan disbursements we've done in any month in HDFC's.
Meanwhile, Tata Power fourth quarter net profit jumps 48% at 939 crores, which surpassed street estimates. Margins, although flat on a yearly basis, surpassed estimates at 15.5%. The board of Tata Power recommended a dividend of 2 rupees per share for the fiscal 2023. BQ Prime Sajid Mangat spoke to the company's MD and CEO Praveer Sinha about their Q4 performance and the significance of the Mundra plant amid India's rising power demand. Listen in.
We, of course, have the challenge of Mundra, where we continue to operate the plant under Section 11, and hopefully it may get extended till the end of the year. But nonetheless, what we are seeing is that Mundra has to find a permanent solution, and there is a lot of interest in discussions with the procurers, because it makes sense for everyone, because Mundra is one of the low-cost supplier of power. And it also is there in the merit order, so it makes a much more sense for the buyers of power to get supply from Mundra, so that the overall cost of power procurement reduces to them. And for us to also to come to an arrangement whereby the arrangement is better than the PPA, so our under recovery is much less. As the power demand continues to rise, there is a necessity to operate these imported coal-based plants. Otherwise, with the coal prices at that time, it would have been financially absolutely unviable for any of the imported coal-based plants to operate. Having said that, it is also a fact that Mundra is one of the most efficient plants, and even if under Section 11, it continues to be in very good shape in terms of merit order. So I think there is a realization on all sides that it makes sense to have a permanent arrangement for Mundra.
And switching tracks to the prolonged funding winter of Indian startups, the startup ecosystem fails to find any relief as the funding winter continues. Funds raised by startups declined by about 75% to 22,934 crore rupees in the first quarter of 2023. Macroeconomic headwinds globally have played spoilsport for this ecosystem. It's the workforce which is bearing the brunt. In the latest round of layoffs, Meesho has handed the pink slip to 251 employees, and there is a long list of nearly 100 startups who have fired employees. Rishabh joins us with further details. Rishabh, what is ailing the startup industry?
Right. So it's startups and tech companies globally, from Twitter to Uber to Meta and Google, everyone has exercised mass layoffs. Now, the reason primarily for that is the overhiring that was done during the pandemic. Funding in tech companies soared during the pandemic as people stayed inside their houses. The usage of tech products boomed. And so their valuations also soared, and the people that they hired also grew. Now, that environment did not last very long. The pandemic has receded, and access to newer capital has become very, very tough with rising interest rates. And now companies have had to prioritize profitability over growth and scale. This was not the norm for venture capital-backed companies earlier. Their norm was to blitzscale, become a household name, irrespective of the bottom line. In fact, today, Meesho's founder and CEO, in an email to employees, acknowledged that they made quote-unquote judgment errors in overhiring, and now in order to be profitable sooner, they need to be much, much more leaner. So this phenomena of prioritization of profitability over growth and scale will stay.
Right. Thank you, Rishabh, for that update. That's all we could pack in this edition of Let's Talk Business. We'll be back on Monday with the top business and market stories. Do stay tuned.